Hello everyone, welcome back. We are now in Chapter 3, Strategy in the Market, Strategic Pricing Decisions. In this chapter, we discuss four key themes. The traditional pricing models based on neoclassical economic theory and accounting methods of pricing. Then secondly, strategic pricing based on market segmentation, targeting and positioning. And thirdly, we will discuss life cycle costing as a specific pricing framework. And then finally, we will discuss target costing, not only as a pricing technique but also as a framework of strategic cost management. So let's start with traditional pricing models. So that is the focus of this video. So traditional pricing models, as I mentioned earlier, include two different or interrelated frameworks. First one is neoclassical economic theory of pricing, and secondly, accounting framework or models of pricing. So in terms of economic theory, the starting point of pricing is the assumption that the ultimate objective of a firm is to maximize profit. So that's the neoclassical economic assumption about the objective of a firm. So if you assume, and if you consider that the ultimate objective of a firm is to maximize profit, then all the decisions that the firm should make should be directed towards that profit maximization objective. Then, how do you determine at which price and at which quantity the price will be or profit will be maximized? So there is a mathematical rule widely adopted in neoclassical economics. That is, the profit will be maximized when the marginal revenue is equal to marginal cost. So therefore, the economic theory indicates that the optimum price, the equilibrium price, or the best price is the price at which marginal revenue equates to marginal cost. So that's the basic understanding of economic theory. So we have studied this one in basic economic courses. So as this diagram explains, this is about economic pricing. So there's a demand curve, and on the basis of the demand curve, which is the average revenue curve or the price curve, then you can derive the marginal revenue curve. Then you compare or match your revenue curves with the cost curves, average cost curves and the marginal revenue curves. So mathematically, you will have the marginal revenue equation or function and the marginal cost function. You mathematically equate both these functions as I have explained in the chapter and ultimately find the point at which profit is maximized. So that will indicate what is the price at which profit will be maximized. So that is the economic theory of pricing. So in terms of strategic thinking, if you think about strategic positioning in the market, this economic model of pricing is a very weak model of pricing. And there are some fundamental issues or weaknesses in this neoclassical economic model of pricing. The first weakness is that the problem of profit maximization objective. So in the real world, companies may not always try to maximize profit. Profits are necessary, profits are essential, but they may not be necessarily trying to maximize the profit. So they would have what you call a profit satisfying objectives, or to achieve a satisfactory desired level of profit, but not necessarily to maximize the profit. So given the particular strategic scenario, it could be better to introduce the product at a lower price, even though that price will not maximize the profit. So that is one argument against the neoclassical economic model. And then this model also conceptualizes the competition, the competitive terrain, in a very narrow sense, only on the basis of the demand curve, which is the relationship between price and the quantity. So it's a narrow conceptualization or incorporation of the nature of the competition. So as we discussed in our chapter 1 and chapter 2, we understand in strategic terms the competition or the competitive terrain is a complex condition. It includes so many variables. For example, simply if you think about Michael Porter's market or the industry analysis framework, the competition has to be considered at least in 5 different forces. Rivalry among the firm, bargaining power of the suppliers, bargaining power of the buyers, threat of new entry, and threat of substitutes. So that's how the strategy discourses understand the nature of the competition. But in neoclassical economic model, the conceptualization of competition is very narrow. It is only on the basis of the demand or estimated, forecast, or possible demand curve. Then, in this model, there's a very limited agency attributed to the firm. The strategic agency attributed to the firm is very limited. For example, if the firm is operating in a perfectly competitive market, then the firm is simply a price taker. And then finally, this economic theory assumes that the firm can determine a strategic price, the appropriate price, as a singular variable on its own, without any connections to the other marketing decisions or market related decisions that a firm should make, the positioning decisions that the firm should make. So that is a fourth weakness of this framework. So neoclassical economic model, well established old traditional model based on the profit maximization assumption and the marginal revenue equal to marginal cost rule determines the price at which the profit should be maximized. And there are at least 4 fundamental weaknesses in this model in terms of considering the strategic positioning. Then let's move to accounting model of pricing. The accounting model is rather simple. It is called cost plus pricing. So the accounting model is simply calculate the total cost of the product, then plus add the desired margin of profit, so you ended up with the profit price. So as this diagram indicates, so you first estimate the cost. The cost estimation needs to be understood in terms of the direct cost as well as indirect or the overhead cost. The calculation of direct cost is relatively easy because the product design and manufacturing designs, bill of material, etc. will specify the amount of direct labor, amount of direct material, and amount of direct expenses to be incurred to produce a 1 unit of the product or service. So it is relatively easy. The challenge is the absorption of overhead expenditures. So you should have studied this overhead absorption in your previous management accounting courses. So you may absorb the overhead on the basis of traditional overhead absorption method or activity-based costing method. So either way, so you have the direct cost, then you absorb the overhead on the top of that, then you end up with the total cost. Then add the desired profit margin to calculate the price. So that is a simple accounting model of pricing. And it is simple and widely used, but still this method is not strategically very sound. There are fundamental weaknesses. First one is this model has no consideration at all about the competitive conditions, the market conditions, at least about the demand. Secondly, it starts from the production or production oriented method, start from the factory and manifest a push strategy. So from the factory cost, add the profit and to the market. That's called a push strategy. And that is basically all inefficiencies that a firm may incur during its production and distribution, all wastages that a firm may incur during its production and wastages will add up to the cost. And then on the top of that, the firm will add a percentage margin of profit. So that basically means all the wastages and the inefficiencies together with the topping up profit margin will be shifted to the customer. The customer has to bear all the inefficiencies of the firm. And this could be okay in economic terms, accounting terms, if and only if the firm is a monopoly and if the customer has no bargaining power. If the market is a competitive market and if there are efficient firms, competitors operating in the market, and then this kind of accounting or push strategy based pricing technique would not work, because the customers will not be happy to pay that price and buy your product. So especially in a very competitive conditions, this cost plus pricing is not the best method to apply. So those are fundamental weaknesses of accounting based pricing. So in total, we discussed economic pricing models and accounting pricing models. They are the traditional pricing models and theories. Both of these traditional pricing frameworks or theories or models are weak frameworks in terms of strategic positioning. So in our next discussion, we will talk about a more strategically tuned, market-oriented, positioning-based pricing technique. And until that, thank you very much for watching this video. See you again.